Welcome back to The Explainer. Today, we're diving straight into the end of the easy money era to explore a massive structural shift that is currently completely reshaping institutional portfolios. We're officially leaving behind a decade of uniquely forgiving market conditions and stepping into an entirely new landscape. So today, we are going to break down the critical transition toward what industry leaders are calling Real Estate 3.0, and we'll explore why unlisted infrastructure is rapidly emerging as the ultimate cornerstone of a modern, resilient portfolio. Here's our roadmap for today. We'll start by mapping out the new alternative era, move into Real Estate 3.0, and then look at the massive rise of unlisted infrastructure. After that, we'll ground it all with a real-world case study on Sydney Airport and finish up with a quick comparative showdown against other alternative assets. All right, part one, the new alternative era. Navigating the end of easy money. To really get where we're headed, we've got to face facts. The super forgiving market conditions of the last 10 years? Yeah, they're officially in the rearview mirror. You're just not going to be rescued by falling interest rates or cap rate compression anymore. Over the last cycle, that environment essentially acted like a rising tide that lifted all ships. It allowed returns to be driven less by active strategic decision-making and more by simply having exposure to the right sectors at the right time. Well, that rising tide has rolled back out, and the market is becoming incredibly discriminating. So we're shifting from a pretty passive era to a highly demanding one. The next decade is going to be defined by strict asset selection, totally ruthless underwriting discipline, and the ability to actually drive real sustainable cash flow growth. Basically, granular value creation isn't just a nice-to-have anymore, it is the absolute baseline requirement. Which brings us to Section 2. Entering Real Estate 3.0 and the operator's advantage. In this new environment, just buying a quote-unquote good building in a prime location, well, it just doesn't cut it. Firms really have to step up and act like true operators now. I mean, look at the massive structural shifts happening right under our feet. Take the industrial sector. Demand is no longer just about port-linked imports. With all this onshoring and deglobalization going on, it's all about domestic manufacturing and domestic supply chains. And then, think about the physical limitations of the buildings themselves. Can a facility even handle the crazy power requirements for modern automation, robotics, or data center growth? These incredibly specific characteristics are exactly what will separate assets with true pricing power from the ones doomed to fall behind. But, this pivots our focus to an even bigger question. Even if you completely nail the operational execution in Real Estate 3.0, you are still dealing with properties that could, theoretically, have a shiny new competitor built right across the street. So, what if you could invest in an asset with virtually zero substitution risk, literally no competition next door? That takes us right to Section 3, the rise of unlisted infrastructure, the cornerstone of diversification. For a long time, infrastructure kind of just got lumped in with regular real estate and private equity. But today, it is standing confidently on its own 2 feet as a core portfolio pillar. We interact with these assets every single day. Think toll roads. Think massive seaports. These aren't just buildings. They're the essential physical frameworks that underpin the entire economic functioning of a region. And because of their sheer scale and necessity, the barriers to entry are ridiculously high. You can't exactly just decide to build a competing seaport down the road, right? And modern infrastructure isn't all just concrete and asphalt anymore either. It extends deeply into the digital realm. Assets like data centers form the critical plumbing that powers our highly connected, completely data-driven lives. And they exhibit those exact same traits: super high barriers to entry and absolutely essential daily use. So to put a formal definition on it, unlisted infrastructure encompasses the absolute bedrock of society: essential utilities, services, and facilities. But here is the so what for you. Inelastic demand. Unlike a commercial office building or a retail mall, people don't just stop using water or electricity or data just because the economy hits a rough patch. They literally can't. And that inelasticity provides incredibly stable, predictable revenue streams no matter where we are in the economic cycle. Now, when we look at the actual portfolio benefits, things get really exciting. We are talking about holding periods that last for decades, sometimes on 99-year leases. That allows for some incredibly efficient, long-term capital compounding. But honestly, perhaps the most powerful benefit right now is the natural inflation protection. Since these assets operate in near monopolistic positions, they often have explicit inflation-linked pricing mechanisms built right into their regulations or concession contracts. So they act as this huge built-in shield against rising costs. Let's make all this tangible. Section 4. Case study on Sydney Airport, demonstrating attractive investment characteristics. All right, to bring this theory to life, let's look at an absolute mammoth of a transaction. Back in 2022, IFM and a consortium of investors executed a take-private deal for Sydney Airport worth 24 billion Australian dollars. This specific asset beautifully captures the unlisted infrastructure advantage. It's the biggest airport in Australia by passenger volume, sure, but the truly staggering part is the holding period. Their concession lasts until the year 2097. That gives the operators over 7 decades to upgrade the asset, reinvest capital, and just let those returns compound over a massive timeline. And it also perfectly highlights how multidimensional the diversification of infrastructure can actually be. You'd probably assume an airport makes all its cash from landing planes, right? Well, aeronautical revenue is exactly 50% of the total pie, just half. The other 50% is a super robust, highly diversified mix of commercial revenue, retail, property, car rentals, and regular everyday parking. It's just a remarkably resilient business model all layered inside a single geographic footprint. Okay, Section 5, Infrastructure versus Other Alts, the comparative showdown. So we've seen how it works in the real world. Now let's put infrastructure head-to-head with its alternative peers, starting with traditional real estate. The absolute key difference here comes down to scarcity versus substitution. Real estate carries a pretty high substitution risk. There are thousands of commercial properties out there, and we all saw what happened during the pandemic. Everyone went to work from home, and office occupancies just fell off a cliff. Some predict they won't fully recover until 2040. But infrastructure, it benefits from absolute, finite scarcity. There is no alternative to the local water utility or the primary toll road into a city. Because of that, infrastructure cash flows stayed incredibly robust and bounced back really fast post-pandemic, because again, they provide non-negotiable services. And when we stack it up against private equity, the differences are just as stark. Private equity typically involves acquiring smaller businesses, loading them up with high leverage, and trying to flip them in a short 3 to 5 year window. It essentially acts as a leveraged, highly volatile version of the public stock market that's heavily correlated to GDP shocks. Infrastructure goes the exact opposite route. Lower leverage, decades-long holding periods, and essential bedrock services. It completely insulates you from that frantic, short-term interest rate panic that plagues traditional private equity. And if you really want the final nail in the coffin, check this out. Between March 2009 and March 2023, a 14-year period with some massive economic shifts, unlisted infrastructure showed an astonishingly low 3.5% average annualized volatility. Let me put that into perspective for you. That is actually less volatile than listed U.S. bonds. You're effectively getting the returns of a growth asset, but with the rock-solid stability of core defensive fixed income. It's pretty amazing. So that leaves us with one final thought today. As the quote-unquote easy money era officially fades into history, and we step into this highly demanding landscape of real estate 3.0 and essential, scarce infrastructure, it is definitely time to audit your own strategy. Ask yourself, is your portfolio legitimately built with the granularity, the operational expertise, and the finite asset allocation you're going to need to withstand the next decade? Or are you secretly just hoping the rising tides of the past will magically come back to bail you out? Thanks for tuning into this explainer, and I'll catch you guys next time.